Today's the 7th of May. This is Brad Matheny. This is kind of an end of Fed Day follow-up for everyone that's paying attention. Now, I told you this morning I didn't think the Fed was going to make any big moves. The economy seems to be performing fairly well. We have the tariff issues. We have, lots of people coming out and saying we're going to move into a recession. I will be honest with you. I think we've been in a recession for quite some time. I'll come up here and show you. This is the SPY chart. And, okay, good. I don't have any other indicators. So, let's go U.S. money supply. We'll bring up M2. And did it put it up here on the chart? Yes, it did. Move to new pane above. That's fine. So you can see how much money we've actually been printing in the U.S. And global money supply is incredible. Let me get these back. Whoops. Invert, regular. And by the way, really love TradingView. TradingView is just wonderful. I think it's just incredible how quick and easy and painless it is to get in here and do this, but including all my crazy drawings. But you can see here that, we've been on a pretty substantial growth since way back here in the 1990s. I mean, you can see this line is fairly consistent up until about here. That's 2011. That's where we moved into the very broad financial crisis right here. 2009, 10, 11, right in this area, we had the big financial crisis. Then you can see we have a fairly solid trend line moving up to here, which is COVID, meaning that we hadn't gone into any real crisis. This was COVID. Now, I suspect, and now here's what I'm really thinking, guys, is that I suspect we moved into a recessionary trend somewhere back over in this area after COVID. And I believe that we've been in a kind of a recessionary trend ever since. The only thing that's keeping us alive in this recessionary trend is the fact that we printed, such a mass amount of money over the COVID time frame all the way up. That's $6.5 trillion, call it $7 trillion since before COVID. That's a ton of money. Okay, to have that kind of a move, when you think about it back over here. Oh, no, come here. To see a $6.5 trillion move, we would have had to come from this level all the way down 5, 6.5. Basically from 2011, 10 roughly, all the way out to 2020. It took 9 years to present a $6.5 trillion boost in money supply. And after COVID, it took us all of 2 years, roughly 2 years, to produce a $6.5 trillion boost in the money supply. Okay, and that's why I believe the markets have rallied on the fact that we were basically throwing money all over the place. Same thing with global central banks. They were still throwing money all over the place. Everybody was living high on hog. I believe we've kind of been in a recession essentially since this time frame. So I'll mark it like this. And the recessionary trend has simply been the unwinding of this excess money. So something kind of like that as a recessionary channel. I think we've been basically unwinding this excess money. You can see here the amount of money that's been essentially dumped into the economy. And if we add the Fed funds rate or the Fed, let's say US money, let's see if we have something else. Money stock, real money stock. See if it's any different. 6.8 trillion. Yeah, slightly different. But again, the debt. So we'll come in here, add US debt. Percentage of gross domestic product. Okay. Put it up here again. Move to pane below. So here you have this boost here in total global debt from, and again, go back to regular. Oh, that's regular already. We've got a boost of total debt over that same time frame of basically 7 trillion. Okay, and carrying onward out till now, which is basically 4 years, we've got $13 trillion in debt. Yikes. In 4 years. And again, we had from total debt down here, we had about $9.5–10 trillion over a 10-year time frame. So we've really, when you think about it, we've got 13 trillion in debt. We're just printing money. The U.S. economy basically is operating on ether, but that means that the global economy is operating on ether as well. And the ether is money, 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 money. Okay, and money, 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 money. As long as we keep printing, everything looks rosy. And party, party, party until that credit card gets shut off. And that's where I think we're looking at a moderate recession. So now, after this move today with the Fed is basically saying they don't see any real risk. I'm going to come back in here. We're going into weekly trending. We have this consolidation high and consolidation low. The low is actually way down here. So that consolidation low and consolidation high are going to play out for us over the next couple of weeks, in my opinion. I think that we are going to likely stay in this channel, this kind of widening downward channel, as well as potentially this type of downward channel, possibly from here. You can see how that creates a beautiful channel moving downward. And I do believe that as we get deeper and deeper into these legs, remember I highlighted these previous levels. So let's mark this as kind of let's get them deeper as we go. So we'll go yellow here. That's not really good because we don't have any background. So we'll go light blue and a little bit darker, light blue, change it a little darker, and then we'll come down here and we'll set this to light blue, and then we'll set this down here to a deeper blue color, and then we have this lower one down here. We'll set that to a dark blue. And where we're at with this, guys, is that that's the lowest level I drew. So where we're at with this, in my opinion, as we move deep downward, this 474 level is pretty important. And this deeper level, 362, I don't think we get here. There's a chance we could end up back in this area, back in this lower low channel on some sort of a deep breakdown. And what I'd be watching for on a deep breakdown would be, some sort of a crisis event. So, currency crisis, debt crisis, something along the lines of a fairly big crisis event, and it would likely happen somewhere out here in 2026. So somewhere out, let me redraw this, out in this area, end of 2026, 2027. And again, I think that would be, you know, at this point, maybe a 50-50. So where we're at with this move after the Fed is reversion. Now, I've talked to you guys a bit about reversion, and I've talked to you guys about what reversion means. So outside of a bias, outside of some sort of an impetus to move higher, then you're going to have a bias or a bias level, which is going to prompt a reversion. You can see in an upward trend, the best way to look at a reversion is to use a linear regression channel, and you can pick highs, doesn't matter. So pick highs and pick this level here. So I'm going from high to high or from high to high, and it's going to draw a reversion channel that gives me that median range. Okay, if I do, and this is probably a 3 percentage point, yeah, so I'll go to 2 and 2, tighter range. Now I'm going to come out here and I'm going to draw another from this peak over here to this peak. And so you can see that from this peak downward, we've moved into a deeper downward cycle. Okay. Base, I will make kind of a purple color. Up, I will make kind of a lightish green. And down, I will make kind of a deepish purple. So you can see how we've got into this more aggressive downturn. And again, until we have some bias that tells us that, hey, markets are moving away from the downward pressure, the likelihood of where we're at right now tells me that if we don't have any strong economic data, if we don't have any strong printing of money, if we don't have any strong economic growth prompting, 15, 20, maybe percent annual growth like we had back over here, then more than likely we are going to revert back down into this area. Okay. That would be the middle area of this channel and this channel coming down. Reversion is very, very important to understand that price tends to revert on a normal basis. Now, if I go back here to the lows of 2020 and carry the lows out here, look at how fun this is. So we carry from the lows here to the low here, and there's our channel reversion. Okay, that's a 2% reversion. I'll make it 3 because I want you to see something. Okay, so the 2% reversion, let me go back to 2. And it's drawing my colors, which is fine. The 2% reversion on the low channel of the reversion puts us right here, right at this low. There's your 2% downward reversion. And look, we come down here to reach this potential level. There's that low reversion channel. Okay. So you can see that, we bounced off a 2% downward reversion coming back from the COVID lows all the way across to these lows over here. This is a broad 2% pullback in a channel. Now, if we were to look at the 3% chance coming over here, just increase it up to 3. And this is again price reversion. Price reversion would then tell us that we have a chance to move down into this cycle where you can see I've drawn my lower lows, or potentially here, or potentially here. where the middle channel crosses. So you can see that we have that chance of breaking down into a reversion cycle. And the reversion cycle again would put us more than likely into, this type of an area, right where this yellow, well, I'll draw it, but in my opinion, it's like right in that area. So 514, with the potential that we break down on some extreme news moving into this area. But this 3% channel, this broad range, gives us the very strong potential that we're going to try to base and bottom in this area and rally back out, in my opinion. Okay, I think that we're looking at, a pretty, bring the front. I think we're looking at a pretty strong reversion. So the point being that without any impetus, without any driver of economic movement, we are moving into a reversion, and the reversion level right now is right here at this green. I'm going to make it bright orange, is right in this area. So figure 528 to 515. It's right in that area, right between this middle channel that I've drawn here in green. I'll make it bright orange. It's right in between these levels. And why is reversion so important? Well, reversion, you need to understand, price either does one of two things. It either trends or it flags. I've mentioned that to you before. Price either trends or flags. Okay? So, if we do not have any driver for price is likely going to continue to move within this consolidation channel and continue to roll downward into this downward cycle phase that I've been telling you about for months, which is going to put us down into this lower area and or this lower area as an immediate target. So we're very likely going to move into this breakdown phase through this flagging I drew earlier today, and then very likely to move down into this consolidation phase, which will essentially be across these areas here. And then potentially, and again, look at that number, the 503, 504 area to 525. So we're really talking about the same numbers I've been telling you for quite a while. 12, make it 14 so you can see it. And then over here is the 505 area. And those numbers seem very logically probable. Okay, assuming we get the breakdown trigger, assuming we roll into reversion, and assuming there's no new driving impetus for some movement in price. Price either trends or flags. We're in the middle of a consolidation range. We're searching for some sort of a trending. The Fed is still concerned about inflationary, especially with tariffs. The economy, U.S. economy, is still clicking along. We'll see how it does in another two or three weeks, meaning out here into June, July. We may be looking at it, but right now, the whole concept, what I think is taking place is reversion back to this level. I think that's really what is taking place right now, is a reversion back down to this 515, 510 area, and that's where we're going to be struggling for support. Now you can see here, I drew this line. Let's see what it is. It's the cross line between these lows. So from here to, where did I draw it? Oh, that was just a line that I drew across the lows. Let me come in here. Try to get it right off of this low. So what I'm doing here, guys, is I'm referencing rejection points, like right here. So this gives us a pretty solid confirmation right here that this low here and this low over here are going to play out pretty solidly, in my opinion. I think this plays into a very solid zone right in this area for us to be able to really target a fairly, come here, solid support. Basically 505 to maybe, well, we're coming up to 505. So really 505, maybe 499. But this area gives me a very solid idea that price, if we're going to revert, is going to try to come right down into this area. So again, we'll see how it plays out. But, the mechanism of unwinding this excess capital is going to take some time. Given what we're doing, given what Trump is doing, given the fact that we're not seeing the massive stimulus anymore, and global central banks may try to keep stimulating, but it's going to be hard for them, like I told you in the original tariffs video. It's going to be really hard for them to make up the potential lack of U.S. consumption. And like I said, there's other ways that we can handle basic consumption. And America is a very dynamic economy, so I'm hoping that we settle things quickly. But I think really June, July, August is when we're going to probably have things very settled and maybe be looking at some major growth. So, if I were to come out here and kind of explain to you what I think is going to happen, and I've kind of explained this to you before, is that we're going to go through the lows, and then right out here in October, we'll start to move out of this trend, rolling into some upward movement in 2027, and then really start to accelerate upward. So that gives you an idea of what I think is going to happen as we build growth. It's going to take, in my opinion, a good 2 years almost to get back above these highs. I think it's going to take a while to get back above those highs. So we're going to be trading within this range. And I see that until we break this channel, which, we're close right now, we could get a breakout up. But again, I have a hard time trying to see what the big dynamic would be for massive economic growth throughout the end of this year. So unless someone can come to me and change my mind, or we all of a sudden start printing $3 trillion or $4 trillion in the next 2 months, I don't know. I don't know where the growth is going to come. I think it's got to settle first before we find that growth move higher. Okay, guys, that's it for now. So, my analysis hasn't changed. The big news today was the Fed didn't decide to do anything, and inflation seems to be on their focus. I did read that they are trying to maybe change their mandate. I think that has to do with global market concerns. But we're going to just have to play this by ear and see what happens. Personally, I think the global markets are going to really start to digest what happened in the U.S. markets today. Markets just started ticking away, and S&P's down a little bit, NASDAQ's down a little bit. Dollars are down quite a bit, actually. We were back up at 101 before. 2 days ago, we're down almost 1%. And like I said, we'll see how this all plays out. Gold should eventually really start to hedge the risk that goes on in the market. But right now, I wanted to give you my 10 cents, 2 cents, whatever you want to call it, nickel, and just tell you that, I really do believe right now that lack of any driving bullish trend, I think we've been in a recession since way back over here, as I shared with you. Come up here, and I think this has been a broad unwinding of the COVID capital that's been thrown at the market. And something I could do to show you a little bit is this. Come back to weekly and back over here, shrink this down. And so if you want to have a little fun and understand that, you know, where we went pre-COVID, all you got to do is pick a low level up to a high level here, and this will get us the standard channeling. That's a 3x deviation prior to the COVID move. Okay, so now we come in here. That's a 3x standard deviation channel prior to COVID. And look at how clean this is. This basically tells us that that possible deep low right over here is and would be a moderately strong unwinding of this excess from COVID. Okay, if you look at what we have from COVID, and you look at this big rally where all this money got printed, rolling back down into this level, potentially, and moving up out of it, would be a fairly solid unwinding. We've done it here through COVID. We've done it here through the bottom in 2022. You know, if we were to unwind down into the 430, 440, 420 area, in this area, I think that we'd be looking at a fairly solid unwinding of excess capital, moving us into a very strong growth phase. But it's going to freak out a lot of people if we get down to 400 on the SPY, or 410 or 420. Just let you know, everybody's going to be screaming, and those poor people that are buying the dip right now, thinking they're catching a big move, it's going to look pretty bad down here. But again, just be patient, play what's in front of you, and these linear regression channels can be very helpful in understanding, you know, where we're at. So in theory, this blue line right now, we haven't gotten below that blue line yet. We did on the deep low early last month, mid last month, on that deep low at 480. So this was below this level, showing price could continue to contract. But at this point, I think we consolidate and then maybe move into a deep consolidation low, then try to battle our way back out of it. Okay, guys, I'm going to leave it right there. And good luck tomorrow. Let's see what the global markets do after today. Talk to you later.